Are we on the live? Yo, shake my hand. We are live. Sorry about that. 365, shake my hand. Hope you guys are doing well. Good evening. We are tracking some big data tonight on the live stream. We'll be looking at a couple of things. If you don't know, my name is Leroy James, my series, head trader of 365 Trading Academy, supply and demand trader, smart money concepts. That's what we do on this channel. I'm not part of the stupid debates going on right now in the retail faction about smart money and trend line traders. It's just dumb. All right, figure out a way to make money, make it consistently, and motivate and keep your craft. Right, guys. So the main thing there, I've already got the live stream open, so we're just gonna wait for this. Remember, this is gonna drop at 8:30 p.m. Right, but what's gonna happen first is we're actually going to get the actual data on Forex Live. All right. And so I'm going to have that in the background. For those of you who don't know, we are expecting a feedback loop. How bad is it? Oh. What's up, bro? Samuel, good to see you. Is it sorted now? The feedback loop, are you guys good? Just let me know in the comment section there. I'm not even sure I would know how to fix that, but just let me know if it's good. Or if something's going on, it's annoying. Okay, so Alvin, I'm just gonna wait for you to let me know if it's good. Right, so we are expecting 50 basis point today, even though Powell promised a 0.25 for the next following meetings, right? But the reason why a lot of market participants believe in 0.50 is and I'm a part of those people. Still looping. Oh man, that's annoying. I'm not even sure. Okay, all right. Sorry about that, guys. Sorry about that. I don't even know how to fix it. It's the first time it's ever happened to my live stream. I just want to see what it looks like. I mean, I wouldn't even know by looping what that looks like or what it is. Just give me 2 seconds, everybody. We will have a good stream. We will have a good stream trying to fix the loop. I'm not entirely sure how I'm going to do that. If anyone knows how to do that, let me know. I'm just trying to see what it looks like. Otherwise, I might have to restart the live stream. Okay? I might have to restart the live stream. I'm not entirely sure how I'm going to do that. If anyone knows how to do that, let me know. Looks cool on my end. Looks cool on my end. I'm a bit confused. Okay, all right, fantastic. Yeah, thank you. Yeah, because you got me confused there. All right, cool. No, let's get it. Right, so Powell, the last time we did this live stream together on the 16th of March, he promised the markets 0.25 basis point, continuously. Now, interest rate hikes normally will strengthen the currency of that country, so the dollar should go up, right? Number one. Number two, monetary tightening policy or interest rate hike would actually go against assets. So stocks, NASDAQ, all those assets should fall. Now, in March 16th, we had the reverse of that. We had a big rally 2 days before the FOMC meeting, right? We called that the bottom. We predicted that on Valentine's Day on this particular channel, and it happened. FOMC spoke, and what he said, even though he gave the markets an interest rate hike, number one, that interest rate hike was highly predictable. Number two, it was priced in from January. So the dollar rally had already happened before the interest rate hike. I want you to understand this, right? So maybe it'll make more sense if we quickly go to the charts as we wait for them to drop the news, right? So I'm going to go DXY right quickly here. Right, so the rally happened because at 365 in our module 1, we speak about how markets price in everything. All right, markets will always price in everything. So because of that, if you go on the daily time frame and if you look back to that big rally, the big bottom that we kept speaking about in the channel, the rally had already happened. Then the dollar got to an actual supply. So that by the time the interest rate hike, the first one that was already priced in somewhere in here, there we go, the 16th of March, this big rally was markets pricing in. All right, that already. Okay, now what's going to happen today, in my humble opinion, and I could be wrong, and I'm happy to be wrong about it, because I like trading after I get more data. I'm in a couple of positions. Those of you who've been following my war rooms, you would know we're two big higher Nasdaq sales that we're still holding. We closed out the very, very big swings from January, which is unfortunate. And then there's a potential in front of us right now to get into some more Nasdaq shorts. I mean shorts, not longs, shorts, right? And that's just my thinking. But in last month, so in March, so the last FOMC meeting, as Powell was speaking, right, during the press conference, he started to massage, the equities market. He started to say things like jobs have been good, numbers are good, economy is stable, right? So these are the things to look for in the brighter side. And because of that, I don't see the need to become as aggressive. This was in March. And so the stock market rallied for 2 weeks. Straight after that, on the 16th of March, we go to Nasdaq chart. There was an incredible 2 weeks rally. Since that time, if you watch my previous video, and it's now 8 p.m., so let's just keep checking and refresh this area here. Since that time, right, what's happened is, more good news has come about, right? So the markets are now, and there we have it, folks. We've got a normal, interest rate hike. He's giving us 50 basis points as usual, as I told you, right? There we go. Markets, all this is priced in, okay? We're looking at the Nasdaq, 15 minutes, H4 supplies all broken. But if you know our rules, you will know that this supply was broken about 2 or 3 days ago. I want to give it to you on the daily time frame so you can actually see what we're working with. All right, so the mystery is done now. Interest rate hikes are normal. We got a 0.50 basis point interest rate hike as anticipated, I guess. Now we wait to hear what the man's gonna say within the next 30 minutes. And if you are cool with me, I can then walk you through some charts, right? So markets are now gonna be bomb rushing into this interesting cluster. Now, I spoke about this cluster on the Nasdaq on Sunday during the war room. I said, your first point of call where a lot of high risk trading is going to happen somewhere in this particular area. I said for any selling to occur there, markets first have to kind of like make contact with these daily supplies, right? And that's what's happening right now, right? So off the back of the interest rate hike, etc., that's exactly what's happening. All of this could change in 30 minutes. Those of you who are planning to trade right now, my advice to you is to slow down, hold up, because all of this could change in the next 30 minutes when Powell comes live somewhere here. And we're actually going to have a good listen to that, right? But the long story is the Fed is a bit behind, number one. All right, the Fed is struggling with a couple of issues, right? ADP today came out with some shocking data, right? If you see the ADP came out, negative, right? Literally, expectation was 382K jobs, and we actually got 247K, which is about 135,000 jobs, lost or missing, somewhere around that area. I got very lucky and I had the opportunity to read the report before this particular live stream. And I'm going to pull out one thing in particular here. Those of you who understand basic economics, you would know that, in a country when dealing with employment, so like I'm in South Africa and there's a high unemployment problem, right? The biggest sector that needs the most support is small businesses. You see, your small businesses have the capacity to actually hire more people, and that's where most of the jobs were lost, right? And they were lost, according to the report, due to massive competition from bigger corporations, etc. But this is a problem right now. I don't think this will change anything with regards to what Powell is going to say. That particular momentum is done right now. But what's important in today's meeting, right? Remember, once you get this, what becomes important, what the FOMC is going to say. If Powell says we've given the market 0.50 basis point, which was already a priced in a rug, right? This was already priced in this massive drop. The market started to fear that an increased interest rate hike was going to come. Remember, good for the dollar. Normally, when you're looking at your structures, map out those supply and demand areas. But in terms of stock markets in general, a tighter monetary policy, more interest rate hikes normally hammer stocks. All right. So you'll see markets react to that, at some point. But it is always prudent to actually wait for Powell to talk. Because if he says today 0.50, we've done it today, and maybe in the next meeting, we're going to go 0.75, right? That means a couple of things. Number one, it means Powell has changed his mind. In March, he said he believes the inflation peak would be in June. If we keep tracking the CPI data, I mean, inflation now is at 8.9%, and that was his peak level. So if we really start to put these two things together, maybe inflation has already peaked in April. And if that's the case, and if I was Powell, I would then think about ways to take full advantage of that particular situation and actually start to potentially become more aggressive now. And if that's the case, then markets are going to have to find a way to react to that, right? Which is normally negative. But you can see here we've got a very sharp, stock rally. Ah, man, apologize for that. And we're going to look at a couple of risk-sensitive assets. So I want us to look at the dollar, Euro USD, Pound USD, S&P 500, just the basics as we start to kind of like lay up a couple of things. If markets arrive at this yellow zone above here, which remember is a strong daily supply, anything could happen there. All right. So on my side, oh, Titus, good to see you, man. Good to see you. Right. So anything could happen somewhere up here. Right. It's not my advice, by the way, to trade these particular news events while they're happening, because it's sentiment and tone that shapes everything, right? So I was waiting for this to happen. About a few hours ago, when the stock market opened, NASDAQ rallied perfectly. I don't want to confuse anyone, but one day we'll talk about beta trades that smart money takes, and this was one of them, right? After pulling everyone down off this particular fears, there were beautiful low buys. On our trading floor, we actually thought maybe the low buys were going to come to 12,800. So full disclosure, I did nothing here, and no one in my trading floor did anything up there, right? If this was going to crash coming down just before the news event, we were hoping it was going to come at least to 12,1800. It matches a very solid order block on H2, H4 daily, and then hopefully see a rally into the announcement of a priced-in interest rate hike, right? Now that we've missed this, for me, I'm just a free spirit tonight. I'm just going to cover the data, cover the news, enjoy the show, and then see where markets lead us, right? So now let's do some chart work, folks, because, FOMC is still talking tonight. And after that, we still have to deal with NFP this Friday. And this is the first FOMC meeting since November where Powell speaks before getting job data. Normally, we get job data, then Powell speaks. So it's almost easy to predict what he's going to say. Why? Because remember, the FOMC only has two mandates: employment numbers and pricing control, inflationary pricing control, right? So we don't know how job data is going to be on Friday, but given what ADP is insinuating, and believe you me, they get it wrong sometimes. We've seen many times where the ADP report and the NFP report is absolutely contradictory. But if we're just going to apply some simple logic here, all right, so this is about 390 as an expectation on Friday. This is NFP. Remember, I'm just going to while up some time until Powell speaks at 8:30, for those of you who don't mind. If you don't want to hear me, you just want to hear Powell, you can then, leave, then come back at 8:30, which is in the next 23 minutes. Right, so NFP, guys, the expectation is 390K on Friday. ADP's expectation was 382. The ADP forecast was lower than the NFP forecast, and ADP completely missed it. About a week ago in the public Telegram group, someone tagged me and they were looking at the jobless claims for the last week. And the jobless claims for the last week were also pointing to some potential, negativity, some potential misses. And now we've got ADP almost confirming those two things. So it would not be surprising, let me put it that way, not a prediction, but it would not be surprising if NFP is weak this Friday. If there's actually a market contraction in the first financial quarter, bleeding into the second financial quarter, I mean, we've seen nothing but blood, right, on the streets here with NASDAQ and all that kind of stuff, right? So now we've got what we call a sweeping flow on the NASDAQ. Remember, like I tell you guys this all the time. I can't imagine the number of retail traders who bought as soon as the news came out and this thing started to rally. This thing started to rally just somewhere here in one of these little candlesticks there. This is on the 15 minutes time frame, breaking these supplies. Every single buy stop taken, every single sell stop taken, right? So stop loss at the top taken, buy limit and the stop loss orders taken, right? This is what we call a very, very dangerous, painful spike, right? Now, why is my chart unclear? Let's go to the H4 time frame and I'll show you. The other lines you guys are looking at in front of you on the NASDAQ here are Fibonacci lines, right? So if I remove my fib was just telling me my point of interest. This was the zone to watch for when the news dropped, right? And I drew it about yesterday. I mean, there were many things left in the Fibonacci. I think the fib was ready to be drawn about 3 days ago or 2 days ago on this NASDAQ chart, right? So this is my latest swing high, swing low. I've done many public lectures on the correct use of tools. By the way, I am a smart money trader, supply and demand trader, and I use trend lines. Right, trend lines are just tools. I don't use them to confirm or to enter the market or to buy or sell. I use them as confirmation measures of my supply and demand levels, just like how I use the Fibonacci to confirm a couple of things. Right, so when I notice this swing high here, all the way down to the swing low, that's where I ended up drawing my Fibonacci. Right, we noticed that this was that golden ratio, or not really the golden ratio, but this was the first point of interest between 50% and 61%, somewhere here. And markets for the last 48 hours, right, since the 2nd of May, markets just kept stopping there. Right, I've got 20 minutes, so let me teach a little bit, because those of you who are excited about module 3, I hope you're ready to learn, because you guys have wanted this thing, and I've made sure it's the best. I've actually published. By the way, those of you who don't know, another part of my life, I'm by design, I am a researcher. I'm an academic researcher in this particular field. So I've finally published my first, I guess, economics article around module 3, supply and demand trading. Right. So it's within an academic trading journal. I'm very excited about that, because the feedback I get from my peers actually influences the way I teach and the way I restructure the course. Right. And so you come across this kind of thing, right? But this is a clean sweep, right? So markets, for some reason, and that's all you need to ask yourself, why, since the 2nd of May, 2 days now, NASDAQ keeps stopping here? And that's what it's done. It's been consolidating at the same place. We had a very big, massive drop yesterday, markets recovered. We had a very big drop earlier on today, markets kind of like recovered, right? And there you go. In my humble opinion, when I see this happen, we can throw in a volume indicator if you want, if you just want to see the number of orders. But when they do stuff like that, markets are generally getting rid of a lot of early buyers and early sellers, which is why I always tell you, it's nice and cool to look cool on social media, right? If that's how you want to roll. But for the most part, avoid trading news events live if you don't know what you're doing and if you're not quick on the reactionary end of things, right? I just want to quickly show you guys exactly what's happened here in terms of volume. Now, in general, we get about 900,000-ish orders on the NASDAQ on a day-to-day basis, right? And it's very difficult to measure on the smaller time frame. So I'm going to move to the daily time frame. I'm just going to pull out the data window so that you can see what's going on today, right? So this is the NASDAQ right now, and we're currently got about 675,000, right? Like very strong buy orders or orders in general in place. But for the most part, it will be continuing this 3-day strike, right? So with 2nd of May up, then yesterday up, and then here we are today on the most part. But markets have done their best to almost liquidate as many people as possible for the last 200 points, right? And if you're a scalper, all more power to you if that's how you want to trade. I just don't trade like that, right? I've been bent way too many times doing that, right? So I'm going to remove my Fibonacci lines now so we can get some clarity, right? So we had a clean sweep here. This is very common just before price is about to make contact with an actual supply or demand, right? There's a liquidity sweep, normally speaking, a nice clean sweeping level where most retail traders will be gathered, or a lot of traders will be gathered, right, before markets decide on a direction. I just want to see this. Hope there's, there is, Samuel. There is. I did go deep, buddy, and just no dates, so I just don't get no pressure. There'll be a free fundamental course also on the course platform, but you won't have to wait for that because everybody needs to start getting busy with module 3, and we still need to go live for module 4. But yeah, a lot of good things are coming. I promise you. I'm quite excited, right? So now it's just up to Powell, right? So let's look at the dollar. The dollar has been on a crazy rally. We've been talking about this. We've just received news that the interest rate hike has gone 0.50. I would not be surprised if the dollar is doing the opposite, right? It's supposed to go up, but it's going down-ish, right? And I'll tell you why right now. Same thing like March the 16th, right? And I'm not making this up. If you get the expected or the actual value, it is good for the currency. I mean, Forex Factor will tell you that. Let's go read here. For those of you who think I'm lying, right? Interest rate, which is actual greater than forecast is good for the currency, right? This is scheduled 8 times a year, right? So we got a 0.25 bump in March the 16th, which made the total interest 0.50, and now the speculation was we're going to jump from 0.50 to 1 full point, which meant we're expecting a full 0.50 again. So 0.50 plus 0.50 equals 1 full basis point, right? So that's what's basically happened, and yet the dollar is falling. Why? Well, let's look at the daily time frame. We spoke a lot about this in my traders war room, right? The dollar just liquidated the biggest supply on the chart in a very long time. In fact, we call it the Donald Trump supply. All right. Now, whenever you break an area of value, you need a lot of power, right? So if there was time and I was well prepared, I would have pulled out, COT data showing you how aggressive they've been on DXY. But we've been talking about this, in the war rooms, right? A clean sweep here, nice imbalance order block, good buying to the upside to really take out this governing supply. And it's the second governing supply that the dollar has taken up. All we are seeing here, and I want you to believe me, everything that's happening in front of you right there, right now, is profit taking. The aggressiveness of these longs, they're going to do a little bit of profit taking. In fact, I would not be surprised, despite what's just happened, that for the next day or two, we start to see a little bit of a break to the downside. In fact, as you can see on my chart here, I've already marked it out. I am really hoping to get into some dollar play, right? I'm going to do absolutely nothing in this cluster. I will not be buying or selling or doing anything. I'm going to let price do whatever it wants to do. But there's that sweeping floor, very similar to NASDAQ, that's going on there. And here it is, as long as the 28th of April, but makes this rearing head again from the 2nd of May, just like NASDAQ. So just look out for that. And one of the things that are going to tilt the dollar, in my humble opinion, is Friday, NFP. My most recent video, which I said watch before today, there's still a lot of good stuff to go back into right there, right? So what I was trying to teach you guys in that particular video was May is cluster choker filled with a lot of dangerous dates, right? A lot of dangers. So make sure we know Powell doesn't start early without us, right? And all these days have a purpose to rock the markets. I said markets are going to look crazy like this. Now, if we want the dollar to go up, because we now have another interest rate hike, it is silly to assume that it's just going to skyrocket from here. Sometimes it does that, but those are normally spikes. If you're looking for a sustainable trend, a sustainable upward movement, you're going to need impulse retracement. Impulse retracement. Markets move in the most basic ways. Once you start to just settle down and really start to understand them. And that's what I feel like the dollar needs. There's no one right now in their right mind willing to buy all the way up here, right? This is way too high after such a strong impulse. At least we've got a consolidation. It would be nice if we've got a retracement and then move to the upside. After all, buy low, sell high, right? So that's what I'm hoping for in the dollar. But anything could happen tonight when the FOMC talks. And if anything does happen, I'm not going to sweat. I'm just going to wait for my opportunity. Anything can happen on Friday, another F, right, with NFP. So, for example, if NFP comes out negative, right, which is literally what ADP is hinting at, right? But we've said before in the channel, ADP could be wrong, right? Maybe tomorrow I can cover some job data. If I sit down and go through all the job claims, it's quite a lot of work to do. But that's how I'm generally never wrong about NFP and all that kind of stuff. Now, if that happens and NFP comes out negative, and remember, if NFP fails to reach 3H2K, which is the ADP speculation, which ADP already missed, right? And NFP comes out, negative 382K below, then that's not going to be good for the dollar. So then the dollar might break out of this consolidation range, and Leroy might actually get that retracement he's hoping for. All right. In the meantime, you might actually get a rotation of money, right? So with the dollar kind of like pending and playing around like that, the next thing I want us to look at as quickly as possible is Euro USD. I see we've got about 10 minutes left before I have to shut up and Powell starts to talk. I mean, I've been talking to you guys about this for months now, right? Powell is behind, 0.25 won't cut it, right? Earlier on, he spoke about the 2000 following Kinley. Thanks, Leroy, for your blessings, man. Blessings. Thank you so much. Sorry, I'm ducking today because I've got an incredible bright light in my face. But thank you so much for being around and learning. Right. So check Euro USD. Right, so we've just got buzz of the interest rate hike. I just want to I want you to understand how markets react. I also want you to really realize where our brothers and sisters, what are they doing, retail traders, where they buy, why they buy. So there's one big candle here with the spike. I'm going to remove the yellow right now. So that was 8 p.m. when that was announced, all right? Again, hike means dollar is strong, right? And then the reverse should happen, stocks should fall. So something like Euro USD, when dollar is strong, should be falling. But because smart money is currently taking profit on dollar and dollar is currently falling, the inverse happened, right? And it's cleared out. And I mean, this is a small level. This is 15 minutes, but most retail traders are day traders. And generally speaking, they don't know how to swing. They don't hold trades for long. So 15 minutes is actually relatively home for them, right? The small time frame are where most retail traders love to trade. If you look at the 2-hour time frame, the cluster is a mess. I mean, I personally, I could never take trades here, but that's just my personal opinion. But we've spoken about the long-term trend of Euro USD many times on the channel. I don't want to beat a dying horse here. Euro USD is weak. Euro USD will continue to be weak. Euro USD has taken out a demand, while the dollar took out a supply. Euro took out the first demand in the way, and now we've got the 3 months demand that we're waiting for. Right, the last break of market structure was somewhere up here. So if I'm right, which is not really what I want to be, I'm not trying to make a prediction on NFP, but let's say NFP is a miss because ADP is a miss, and then dollar becomes weak. That means from today and Thursday and Friday, when that NFP data, you could get a rally in Euro USD. You potentially, right? I see it, right? And that could be a good thing because that's what markets want to do. Markets want to get to a point where they can continue with the business of the day. Euro USD, knowing me, I would very much prefer a sell up here, but that could be asking a lot out of the market. So I'll be looking at confirmed entries here. I'll be using confirmation entries on smaller time frames for this, but this could be a very risky trade. And so I'll go in with a smaller lot size and on a trading account that I really don't care that much about. But for my main swing trades, I really want to maintain a sustainable, momentum, a place to really go. There's not enough power to sell through a demand here, but to sell this high, there's a lot of power to go through there, right? The number of sellers up here and the number of sellers there differ. But again, everything could change today, right? So let's look at a different perspective. We've got 7 minutes left. I will be pausing when Powell speaks if I feel like there's absolutely something crucial that I should explain. And that's because I don't know how many people understand market linguistics, market jargon, what does the trade balance mean? And when they stop in this and that, right? So if I feel the need to explain something that I've never broken down on the channel, I will pause and explain it, right? But, what I would find particularly interesting, so if we're to get a reverse scenario, if all of a sudden Powell says, and maybe even put out a whiteboard for this one, because that's actually quite important. Oh yeah, the whiteboard. Lest we forget why we are here. Folks, if you know this channel, you know this is absolutely important. We do this together for 2 minutes. 1, 2, 3, go. Every day in every way, I'm getting better and better as a trader. You gotta say that to yourself, man. Doesn't matter how much new stuff you have to learn every single day. I am getting better and better as a trader. One day you're going to believe it. You don't have to believe it now. What you need to do now is to say it routinely. 5 times in the morning, 5 times at night. Don't worry about believing. Don't worry about a feeling of faith taking over and saying, oh my God, even though you blew an account last night doing something stupid that you're not supposed to do, you're never going to become this trader. Don't worry about believing it. Just say it out loud. Right. Now, every day in every way, I'm getting better and better as a trader. Because of that, I'm so happy and grateful that money comes to me in frequent quantities on a continuous basis. How do I know this? Because I am still alive today, because I had supper, I'm halfway through my supper, because I have a family, whatever it is. I believe it is true because it has already happened. I'm getting better and better as a trader. I've told myself I am getting better. This is what I mean by it's already happened. It doesn't happen at the happenstance. It happens when you start to affirm it. All right. It doesn't happen when you can now buy yourself a Lamborghini or whatever you guys want. It happens because you're affirming it. Because it's already happened, even if I can't see it, I am already grateful and thankful for everything in my life. Money is forever circulating freely in my life, and I know that there is always a divine surplus, right? I'm weird like that. This is how I got to where I am, so I'm not going to change and switch it up. And so all I do on this channel is to share ways I made it, right? Let's talk about Powell with the next 5 minutes that we have left here together, right? If Powell is already giving us a 0.50 basis point, and if he hints, this is what I need you guys to be listening to today. If he says in the next meeting, if they might ask him a question by the press, if he says, well, we might maintain 0.50, or we might actually start to move at 7.50, right? So a bigger hike. So next meeting, are we going to get this? Or are we going to get that? Markets are going to be like, oh, damn, Mr. Powell is extremely hawkish, right? Tightening monetary policy, increasing interest rates, right? And believe you me, Bitcoin stock markets are going to have a tough time digesting this news. All right, so this would be the rug pull, right? There's already been a mini rug pull that happened a couple of weeks ago, right? That's why NASDAQ and all these assets were selling off, all right? But this could be a potential big rug pull. But here's the one thing that I can't shake out of my spirit. Because he said 8.5%-ish to 8.9 to 9% of inflation would be the peak. And he thought the peak was going to happen in June. Remember, I kept saying to you guys, don't even worry. We'll start taking CPI seriously from August, as we look at these June results. Inflation from April is now at 8.9. If this is the target for Powell, where he believes that's the peak, then if it means that inflation is peaked, Powell might say, so this is like the other side of things that I don't know until we listen to him. He might say, we have done this already, 0.50. In March, we went 0.25. And our aggressiveness has punished the stock market by about 23%, which is exactly how far NASDAQ roughly has fallen. The exact statistics are in my previous War Room video on Sunday when I covered indices. So you'll say, this is good. We've slowed these things down. We are now at a peak right now, and therefore we can then start to slowly become dovish. He's not going to use the word dovish. Dovish is the analysis that we give to the words he's going to use. He's going to say stuff like, there's no need to be aggressive. Or he's going to say, in our next meeting, we might go back to 0.25. If this happens, ladies and gentlemen, if there is an indication that Powell is going to slow down the aggressiveness, if there's an indication that he believes inflation has already peaked and we can now see things cooling down, markets are going to rally like there's no tomorrow. All right, there's going to be massive buys on the NASDAQ. I'm already starting to feel a beta buy. I never take part in beta buys because I am not really fond of them. Number one. Number two, without access to the order books and order flows, I hardly ever experiment with my own money. But if he says something along those lines, if it seems like it's cooling off, cooling down, then believe you me, we're going to have a massive rally. The only thing that would interrupt that rally are two things. Number one, Friday NFP, and next week, the 9th of May, Russia is declaring Victory Day. I don't even know what that means. right? But basically, they're going to carve up a little bit of Ukraine, implement the Russian ruble, and declare victory over this war that they've started, right? And I don't really know, to be honest with you, I don't know how markets are going to view that, viewed as a good thing or as a bad thing. All right, so that's kind of like where we are in the markets, guys. There's a minute left before Powell starts to talk. I want to show you a safe haven asset, just so we have a kind of like an overview. Dollar is kind of like slowing down. Nasdaq was a little bit, pumping up at the news. So let's look at gold, because gold would be the next reactionary safe haven. I actually hate indicators. I don't know if you guys know this about me. I just pulled up that volume indicator just so that you could see, that as much as Nasdaq spiked to the upside, it's not the normal, average buying that's going on there, right? So this is where, on the smaller time frame, we kind of like located some type of sell pressure in gold that I might be interested in taking. Long term, I think gold should fall a little bit. I don't think anyone cares about gold that much, very much rather hedge with crypto in tough times, right? So gold is going up, which is another clear indication that the dollar is actually going down. All right, that inverse relationship, right? So FOMC should start very soon. Can I just get a sound check? Can you guys hear anything? Can you hear that light sound, song, whatever it is, just so that the live stream, you guys are audible? Just need one person to confirm. Are you guys audible? Can you hear the music, background music? Even better, can you hear this Bloomberg guys talking? Can you hear this?
And they're fighting inflation. The thing that I find interesting, I agree with Diane, I love the way she divides this up into a two-part issue. The first part is this inflation battle that we're currently in, and then there's this period that comes later. My biggest concern is that because of the political pressure,
can you guys hear?
If the sentiment in Washington should flip and unemployment becomes a bigger concern than inflation, that the Fed would then find itself feeling that it had to pivot before it reached its 2% inflation target.
Yes, all right. Thank you.
The credibility of the Fed in terms of being viewed as an inflation fighter, and it would probably bring forward my outlook.
All right, so we now wait. We wait. Pretty sure it's gonna start soon. Powell is normally on time. Right, since nothing is happening, cool. And while we're waiting, let's look at more charts. Right, so it's kind of like the outlook, man. This is my outlook on price right now. I'm very much not that invested in this particular market. I am looking at buying more stuff on the crypto space while things remain a little bit cheap. So my next financial notes for this particular month will be scaling myself into Web3. So those of you who are in the financial notes program, please do expect that. I will be investing again this month. On months that I don't invest, I won't then lead you astray. If I'm not willing to do it with my money, I won't tell you to do it with your money. All right, so that's kind of like how I work, right? So gold is faring up quite okay with that reaction. I don't know whether I've got multiple streams going on, my stream, Bloomberg stream, FOMC stream, and all of a sudden my systems feel a little bit slow. But I wanted to kind of like, as Powell is speaking today, I want us to kind of like quickly keep glancing at the Nasdaq chart. We're going to go to the 15 minutes so that you guys can learn about micro movements in price, right? Micro sensitivity and why it's generally difficult to trade this thing during the live, right? This is weird. Should have started by now, right? I think they said 8:30 p.m. Today is Wednesday. It should have started by now, but anyways, it's fine. Right, so Federal Press Conference, 8:30. Yeah, okay, so it'll start anytime soon, any second now. Oh wow, this is the Nasdaq. This is the Nasdaq. This is it's already reacting. I thought it would only drop when he starts talking. I mean, there you go. 15 basis points, right? Nasdaq is now punishing most buyers. Clean sweep, like I said, I mean, this is textbook stuff, but you get people who just do what they want. Right, but anyways, a new bearish engulfing pattern has been formed on H1, so we know we need to see some green to test it. We need to see if market's actually going to go above that clean rejection wick on the H2, another bearish sign. On the H4, you know, it's clean sweep, guys. I mean, my heart breaks, honestly, for retail traders, but what else am I going to do? It has started. Thank you.
Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings.
Sorry, guys. It's important, right? So he's just told the markets that, look, we are still, we've put on the table and we're going to do this thing again. We might go half a basis point again. All right. So that's something that the market is going to start pricing in now for the next 2 weeks. All right. So when I say the sentiment of the week is this, markets just hit. I mean, he might change his mind in the statement, but I'm going to break it down step by step. All right. The other stuff you guys already know.
We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy.
Don't forget to like my video.
And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner, allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy.
That's positive.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay, so this is the whole point of the meeting now. All these important news people, CNBC's in the house, blah, blah, blah. This is where markets are about to dance. Every single question that and how he answers it matters. But just to give you a quick taste of that beta buy I was talking about, right? So we wanted price to come to 280 on our trading floor today. Didn't. So I told everyone to do nothing. I mean, sometimes they listen, sometimes they do their own thing. But look at this full-blown buy rally at about 5 p.m. So about 3 hours ago, right? Push price up for a good sell high. Clean liquidity sweep on this particular area, right? Those people, fundamental traders who generally buy the news, bought only the spike. Please, I don't want to lie to you. I want you to understand what I'm saying. And if you're one of those traders, then you know I'm talking to you, right? At 8 p.m., when you thought Nasdaq was bullish, every single one of you bought the spike. And immediately after that, they've brought price down, but not only brought price down, they've reduced about 70 to 80% of any profits during this rally that most people didn't catch, right? And if they did catch, they caught it after the momentum buy, because indicators, traders use indicators, would have first dictated this big momentum run from here, which means most buying started happening there. And if you're looking for support and resistance, then your stop losses were anywhere from this red line all the way to about this area, which has been liquidated again. All right. So that's the state of the markets right now as Powell is talking, right? So now we're just going to do the Q&A. They normally last about 20 minutes, and then we're going to call it a night.
Nick Chamaros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration, really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think throughout.
The wage thing, guys, very important. I always speak about this in any NFP prep video. So in the last video, I said watch before Wednesday. I told you guys on Fridays, look, that's when I have my therapy, right? And my trading coach and my Friday afternoons I miss. So I can't actually trade NFP with you guys live anymore. But when NFP drops on Friday, remember you're looking at the job change number, but look out for the wage spiral, that wage month over month. I think it's 0.4 for this coming Friday. If it's too hot with high inflation, you've got a wage spiral problem. Markets are going to react negative to that. Unemployment was the first question, right? I think their target is 3.5%, yearly. All right. And Wall Street Journal guy just said it's 3.6 right now, which is good. That's good. You're meeting one of your targets. Remember, all Powell cares about is not my portfolio, it's not your portfolio, it's not your trading account. He cares about keeping unemployment at 3.5 or even lower, if that's even possible, and price. All right. And that's what he's speaking to right now. So this coming Friday with the NFP report, wage month over month is going to be the highly scrutinized piece of data in the market, right? If it comes in too hot, that's bad, because you can't have inflation, increasing prices, and a wage spiral, right? That's just equals recession, right? Type of thing.
Through further healing in the labor market, higher rates, for example, of vacancies.
Blessings, man. Thanks for the comments, guys.
And more
Please
people.
don't forget to like the
we
video.
Like to think that supply and demand will come back into balance, and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the beverage curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as
what they're talking about is this thing that I told you guys to look out for. Job listing openings that dropped on Tuesday. I'm not a fundamental trader. Just those of you need to want to know this extra stuff, right? So it's basically saying there have been more openings. There are more jobs available in the economy, right? So 1:9, literally, if someone really wanted to find a job, they could reasonably find one, right? So that's what he's saying. That's why he's saying the job stuff is okay. We're doing well. And you can see, I say it was the first thing to look out for this week. And we got job listings. It came out very positive, right? They're expecting 11.19 million, but actually 11.55 million were generated. So that's a big deal. So that's what they're talking about here.
We could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will. And I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about
the 5 minutes time frame.
Rate hikes or the possibility of them in coming meetings. Might there be something larger?
Power of these questions, right? We're about maybe 2 minutes, 3 minutes behind the live because I keep pausing. But that first question, he basically said the economy is strong, jobs are strong, right? He's massaging the equities. He knows it's just hit them with a big interest rate hike. Now he's massaging them. Look at NASDAQ, right? Straight as soon as he said that, check this out. I'm on the 5 minutes time frame, and markets have rallied straight into that supply. Now, based on how this meeting ends, we will then now know the true strength of this, very big mitigated supply above us here on the daily time frame, or if markets are going to go for the higher one, where preferably I would love to wait there, right?
Than 50 is 75 or a percentage point possible. And perhaps you could walk us through your calibration. Why 1 month or one meeting should we expect a 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
This is important.
Sure. So 75 basis point an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that the core PCE inflation is perhaps either reaching a peak or flattening out. We want to know more than just some evidence. We want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate? Or
I don't think the 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. It's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is, if we see what we expect to see, then we would have 50 basis point increases on the table at the next two meetings.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty, and the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You know, you're going to raise rates and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
We don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Sorry, guys. I mean, I don't want to pause all the time, but you see what I was talking about the dollar, right? That they're going to use this opportunity to take profits. There you go, right? So now, if you remember, those of you who are subscribed and follow all the videos, God bless you. I hope they're helping you. I've spoken to you about perfect levels, perfect setups in the chart that look so easy. You know, you put it in front of a 4-year-old, teach them supply. By the way, did you hear how many times Powell said supply and demand? This is how the institutions think. You know, go debate with whoever you want to debate with. But I'm simply saying, this is coming from the freaking biggest reserve chair of the world. Keeps referring to supply and demand. Anyways, this is a big thing to always look out for in your trade, especially day traders. As a swing trader, it doesn't matter to me because I don't always see this happening before it happens. So it doesn't affect my psychology as much as it would if you're looking at the charts every single day. And we'll talk about that in trading psychology. But I've spoken to you guys about a couple of things, right? And in module 3, we're actually going to use a very specific schematic, right, to track all of this happening before it happens. But such big volume-based candles, I think last time I said, just think about it as an arrow. The first place that an arrow, a strong, really good arrow, when someone shoots an arrow, the first form of contact that an arrow makes, the first level that an arrow makes, that place is generally destroyed because of how fast that arrow was coming across, right? So I definitely am going to avoid that little Piccinini order block in there, even though under normal circumstances it would have been a good trade. So watch out for this. There's still a lot of selling to happen on the dollar, not like a lot like weeks, right? But in between today and Friday, right, it's going to be quite tough for the dollar to survive. People need to take profit. So if I get out of the H4 and I move now into the daily, right, I am aware that there is zero confluence with where I want to buy. It's just something, if you're trading with me, I want to make sure I map out all the risks. There's no confluence. Rules tell us that areas with zero confluence get burnt. But we get burnt here most of the time. Not all the time, but it is not in line with safe trading. All right. So part of me must be very careful whether I just want to get into the dollar because I got exited out of a 1-year swing and my psychology is just on a greedy thing right now, or I should just happily wait for price to come back all the way down here. This answer will literally be revealed to us by Friday. All right. So dollar is falling, like we said, which naturally you would then see the other thing that we spoke about before this meeting started, that gold is probably going to do well for the next few hours. A few hours, I'm talking 24 to 48 hours, right, on the day. Those of you want short-term trends. I love my long-term trends, so you won't catch me in this type of place. But gold should be doing fairly well, right? So there's gold there on the daily, all green. And if you look on the 2-hour time frame, as the dollar was giving us a big red candle, I'm pretty sure gold was giving us a very big green candle, right? Perfect, right? So everything is kind of coming together, all right? But same thing exists right now. Would I still want to sell here? This is kind of like that stuff. I always tell people, war rooms are great. We give you beautiful swing trade ideas, but you have to take the course to understand the complexities of the rules. Because when things change and Leroy is not there with you, you are going to have a problem. I don't feel excited about selling gold here anymore because of the volume behind these buys. It definitely remove the supply. So these two supplies are slowing down the dollar. But for the most part, I don't feel safe anymore because of the velocity behind this arrow, right? So if I don't get a distribution by tomorrow, markets trading a little bit sideways, if I don't get that liquidity sweep, something, then I definitely don't want to sell there. I want to go quickly delete that pending order. All right. And then look for the next best thing. Okay. Just explaining the logic.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks from the demand side. And I wonder what you meant to convey by adding those.
Well, so the our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation. And people are going to be suffering from that. You know, people almost suffer more from food and energy shocks then, but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So they're two further negative shocks that have hit really in the last 60 days, 90 days.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look.
Sorry, guys. I hope you guys understand. When they keep referring to demand, they mean demand in all different factors. But remember, we buy at demand. So if he's going to crack down on demand, if there's a job to do on demand, it means he needs to slow down spending in the economy. And in my previous video, I spoke about that. Demand means coming on assets, homeowners' wealth, stock investors' wealth, right? They have to cripple the demand of the economy because they can't correct or fix the supply chain problems or the supplies in general. But if they slow down market spending, they are hoping to make a connection with inflation, right? To drop inflation, right? So there's a very big question about what's going to happen to assets in the long term.
It's essentially almost 2 to 1 vacant job vacancies to unemployed people. There's a lot of excess demand. There are more than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored. And I mean, that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. So two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough?
Yeah.
Needed another leg down in equity values to think that households are going to stop spending at the rate you need?
He's literally just asked the point I've just made right now. Have you suffocated demand enough? Stocks, housing, blah, blah, blah.
Stop spending.
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really, you've got to get to a place where the labor market appears to be more in balance. And that depends not only on the level of those things, it depends on how well the matching function in the labor markets are working. Because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1 to 1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, the 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy, and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner, the better.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you talked in the past about consumer spending and how that's driving the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. You look at the labor market for people who are out of work and looking. There are lots of job opportunities. Wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly, it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents, who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances; it is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation? It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job given all the factors that are happening, to try to sustain maximum employment and price stability. So, if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that. Stick in our lane.
So many questions today, man.
Steve
Whoa.
Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you've recently spoken great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, soft landing is the big hope of everyone. Would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
Paul Volcker, guys, in the 1980s was pretty much Powell back then, but he was aggressive, like 1 basis point, 2 basis point, very aggressive with interest rate hikes, which shot America into a recession. So when they talk about soft landing, it's pretty much what Powell wants. He doesn't want to Volcker the market. So Volcker the market is a big rug pull, aggressive hawkish stance to quicken the pace of getting out of that inflationary period from the golden capitalist ages in the 1970s age. So that's that Volcker. Paul Volcker is like a very big power back then, so that's what that meant.
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. It wouldn't hesitate if that's what it's taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. But I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody really, and so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles, and it was racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. This is we have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side. And we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Thank you. Chris Rugaber and Associated Press. Earlier, you just
said that if necessary, I think was the word that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels, given where inflation is and the hot economy is, or certainly the hot labor market as you described it. Why still the hesitation? I mean, shouldn't it be? What else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. You know, the point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, you know, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of
Thank God I didn't close the
Tesla.
Tesla.
Concerned about Fed credibility with the American people.
So why June 1? It was just pick a date, you know, and that happens to be
Crazy, man.
that happened to be the date that we picked. It was nothing magic about it. We you know, it's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I mean, I would just stress how uncertain the effect is of shrinking the balance sheet. You know, we run these models, and everyone does in this field, and make estimates of what will be the how do you measure, you know, a certain quantum of balance sheet shrinkage compared to quantitative easing. And you know, these are very uncertain. I really can't be any clearer. There won't be any clearer. You know, people estimate that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And you know, our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that, and so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that. So, in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, you know, very appropriately. Not to bless any particular day's measure, but the way financial markets, you know, the forward rate curve has tightened in response to our guidance and our actions, really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points,
And that's all through the economy. People are feeling those higher rates already. And so that shows that the markets think that our forward guidance is credible. And I think that's, we want to keep it that way.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing with inflation and allowing it to become entrenched.
Right.
Thank you, Chair Powell. Greg Rubb from MarketWatch. I was wondering if you could take a step
Big
back.
arrow in the supply now.
In March, the dot plot had looked like steady quarter point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month, inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got three or four really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have. Ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing, and it's just us adapting to the data and to the situation and using our tools to deal with it.
Last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices, and maximum employment, especially when the unemployment rate for Black workers is still roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So that's one thing I would say, and that's important. But to your point is this: I do not at this time see the two sides of the mandate as in tension, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion too. That's the good thing, is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
He legit will just walk out here. He won't take another question. There we go, folks. 365, everybody. Right, guys. I actually thoroughly enjoyed doing this stuff. Pretty much used to watch these by myself in silence or with my team if they're not watching or whatever. So it's nice to do it with you guys on the live stream. Right, so pretty much, I can do a summary tomorrow after I sit through the stuff, but he's massaged the economy, he's maintained his stance. They are a little bit worried. They've given 0.50 basis point. You can see it was priced in, and now markets are starting to look for recovery, all right? From a technical analysis perspective, what I want you guys to start doing is starting to learn your structure, right? So what do I mean by that? You want to see a couple of basic stuff. Well, what are the markets doing? Are they starting to recover? They're going to go up? I mean, we can talk about this holistic look on the markets on Sunday, right? But I've got two points of data here: swing highs, swing lows, right? Actually a low and then a lower low, and then markets kind of like trying to almost create a recovery bottom, right? I will be in none of these buys, but that's just me, okay? Something has happened to my camera. I apologize. I don't know what's going on, but I want you to know I will be in none of these buys. All right, that's kind of like just how I am. I literally won't be in any of the buys for this week, right? Up until I'm absolutely satisfied with price. All right, I'm trying to fix the camera while I'm talking. Right, cool. There we go. Right, and then sorry, man. It's the end of the video, anyways. Right. And I want to see a couple of things. There is a small area here that would remain slightly fresh, and that's really sitting around, I want to say 13,700. I'd look out for that, but I still think markets are still going to be a little rocky up until Friday, right? Now we need to see. He's just spent the whole meeting, talking about strong job numbers. Yeah, but you saw the labor. We got more people wanting jobs than the economy can supply right now, right? He's really humping on what they're doing very well, which is the labor part. So if NFP disappoints them, it's going to be very interesting. But until then, avoid trading in areas of value where you get a strong arrow like that with no distribution. That's important, because this is just an indication. These are people who just bought right now, right? The candlestick you're looking at right now are people who've been buying nonstop and selling nonstop, but really buyers have finally dominated since about 8 p.m. when this came out, right? So those people who are waiting here, right, who don't understand that a supply was broken already, have been chowed. The people who first bought when the news came and then markets dropped all the way down here with this week have been chowed, right? So markets came back all the way down to an order block-ish, right, which was not really reacting to anything except for the fact that it was a higher low, and then markets have moved all the way up. My suspicion now is that this is going to be removed, right? I could be wrong. And really that 13,700 is going to tell me what to do next in the markets, right? None of these areas are as fresh as we'd want them to be, and markets have tagged them. Now that that's done, we are really starting to consider the next places where price could really stop, which is, so you'll see this across Euro USD, probably going very up right now. Pound USD, all your risk equities, just listen to what the FOMC say, and the American institutional traders are pumping the markets. We've got about 3 to 4 hours left in today's trading day, right? So a lot of orders are going to be put in. Don't be caught on the wrong side. All right, so if I'm just going to give you an example of Euro USD going up, like we said earlier on, and where we really wanted to kind of like get to somewhere here, then we can start to consider selling if it's valid, right? But all of this is hinged on NFP coming Friday. I appreciate you. I don't want to make this stream any longer than it needs to be. I really hope NFP is negative so that something like this happens, so I can get back to selling. That's what I hope for, but we'll cover this thing, within more detail, maybe tomorrow, but definitely see you on Sunday this week, every Sunday, 4:30 p.m. Shake my hand one more time, ladies and gentlemen. You've been awesome. Don't forget to like the video. Those of you who are still here, those of you who are wondering if I'm just on some boat in Hawaii, I changed my mind about the place where I was going to be hosting the course. I've had to rebuild the entire course on a different website. It's right in front of you. It is not a joke. Everything is there. So if you're already a registered 365 student, please note you will be moved onto the new platform by Monday this coming week, if not the weekend. I will communicate on the public and private Telegram group how we're going to do this. I just like this look. I like this operational flow because I can now build in assessments inside this course. All right, so those of you who want to be certified with a certificate of competence, there's going to be minor assessments that you're going to have to do, but you can do them at your own particular time. But I really like, this particular feel of the course here. So we'll first start off with everyone who's registered, number one, right? By Monday, you should be built in, fill around, have a look, make sure your logins are working well, and then we can then open it to the public, whoever wants to join us after that. If you register before midnight today, you still get a chance to get this course at 75% discount, which is a whooping blessing versus the full $400 US, you pay $100 US. But we've done our best to kind of like be kind and fair and patient and whatever, But I've enjoyed this, guys. 365, shake my hand, have a good night, and I'll see you on Sunday. Peace. I'm gonna walk out like